For decades, corporate cost controls followed a familiar cycle. Companies tightened spending during recessions, froze hiring, cut discretionary budgets, and delayed projects. When conditions improved, those controls were relaxed. Cost discipline was treated as a temporary response to bad times, not a permanent way of operating. In 2026, that pattern has fundamentally changed. Across corporate America, cost controls are no longer short-term fixes. They are becoming permanent features of how businesses are designed and managed. This shift is not driven by panic or short-term pressure. It is driven by experience. After years of economic shocks, volatile demand, rising interest rates, and unpredictable costs, companies have learned that the old boom and bust approach to spending creates fragile organizations. Businesses are no longer willing to build cost structures that only work when growth is strong and capital is cheap. One of the most important forces behind permanent cost controls is the higher cost of capital. When borrowing was inexpensive, inefficiency could be tolerated. Companies could spend aggressively knowing that future growth or refinancing would cover mistakes. That environment no longer exists. Debt is more expensive, refinancing is less certain, and investors expect returns to justify every dollar spent. Cost controls are no longer just about protecting margins during downturns. They are about ensuring profitability in normal operating conditions. Slower and less predictable growth has reinforced this mindset. Many industries are no longer experiencing consistent expansion year after year. Demand shifts quickly, customer behavior changes, and forecasting accuracy has declined. When revenue growth is uncertain, companies cannot rely on expansion to absorb rising costs. Permanent cost discipline ensures that businesses remain viable even when growth stalls. Investor expectations have changed in parallel. Markets are now far more focused on margins, cash flow, and cost structure than they were in the growth at all costs era. Companies that demonstrate ongoing cost control earn credibility. Those that repeatedly promise efficiency but fail to deliver are penalized. Cost discipline has become a signal of management quality, not a sign of weakness. Another reason cost controls are becoming permanent is organizational stability. Rapid expansion followed by sudden cost cuts has proven damaging. Hiring sprees and layoffs disrupt teams, erode trust, and reduce productivity. Companies are learning that maintaining disciplined spending at all times leads to fewer dramatic corrections later. Stability is increasingly valued over speed. Technology has made permanent cost control more achievable. Real-time data, analytics, automation, and AI allow companies to monitor spending continuously rather than relying on periodic reviews. Inefficiencies can be identified early. Processes can be standardized. Cost discipline becomes embedded in daily operations instead of imposed during emergencies. Workforce strategy illustrates this shift clearly. Instead of hiring ahead of projected growth, companies are aligning headcount with proven demand. Productivity and impact matter more than size. Roles are scrutinized, layers are reduced, and teams are expected to deliver more consistently. This approach keeps labor costs under control while avoiding the disruption of frequent restructuring. Discretionary spending has also been permanently redefined. Travel, marketing, consulting, and software subscriptions are no longer assumed to be necessary by default. Each expense is evaluated for return on investment. Many companies have discovered that a significant portion of pre-uncertainty spending delivered limited value. Permanent controls ensure that spending remains intentional rather than habitual. Real estate decisions reflect the same logic. Large, long-term office commitments were once seen as symbols of growth and confidence. Today, they are viewed as fixed cost risks. Companies are downsizing footprints, renegotiating leases, and adopting more flexible workspace models. Reducing fixed overhead has become a long-term priority, not a temporary reaction. Procurement practices have evolved as well. Businesses are centralizing purchasing, renegotiating contracts, and reducing redundancy across vendors and systems. Cost control is now designed into procurement strategy from the beginning. This produces sustained savings rather than one-time reductions during crises. Rising operational complexity has also pushed companies toward permanent cost discipline. Compliance, cybersecurity, data protection, AI governance, and regulatory requirements add ongoing expenses that cannot be avoided. To absorb these costs without damaging profitability, companies must control spending elsewhere. Permanent cost controls create room for these unavoidable obligations. Cost discipline also supports better capital allocation. When waste is reduced, capital can be directed toward investments that truly matter, such as modernization, risk reduction, and selective growth. Cost control becomes an enabler of strategy rather than a constraint. Companies with disciplined spending have more flexibility to invest when opportunities arise. There is a noticeable cultural shift underway. In the past, spending freely was often equated with ambition. Today, restraint is increasingly viewed as competence. Leaders who protect margins and eliminate waste are seen as responsible stewards. Cost awareness is no longer confined to finance teams. It is becoming part of leadership culture across organizations. Importantly, permanent cost controls do not mean indiscriminate cutting. Companies are learning the difference between reducing waste and damaging value. The focus is on eliminating complexity, duplication, and low-impact spending while preserving investments that support long-term performance. Smart cost control is selective, not blunt. This shift has changed internal performance metrics. Leaders are evaluated not just on revenue growth, but on margin improvement, cost predictability, and return on investment. Cost discipline is tied directly to incentives and accountability, reinforcing its permanence. Supply chain redesign has further reinforced this trend. Building reliable, resilient supply chains often increases costs in certain areas. Permanent cost controls elsewhere help offset those increases. Companies accept higher costs where they improve reliability while maintaining discipline where spending does not add strategic value. Institutional memory also plays a role. Many companies experience painful corrections when conditions changed quickly. Those experiences reshaped how executives and boards think about spending. Permanent cost controls are a way to avoid repeating cycles of overexpansion followed by emergency cuts. In 2026, corporate cost controls are becoming permanent because the business environment demands it. Uncertainty is persistent, capital is expensive, growth is uneven. Companies that operate efficiently by default are better positioned to navigate whatever comes next. Why corporate cost controls are becoming permanent ultimately comes down to resilience. Businesses are choosing to build discipline into their operating models rather than relying on reactive measures. This approach may limit excess in good times, but it dramatically improves survival and stability in difficult ones. The most successful companies today are not the ones that spend the most. They are the ones that spend deliberately, measure impact carefully, and align costs with long-term value. Permanent cost controls ensure that every dollar serves a purpose, every investment is intentional, and every strategy is built to endure.